This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Episode 168. Welcome, everybody. And this is a bit of a unique episode where we call an us episode, but we welcome back Ben Rabidoux as a special guest. He was a guest with us back in April of last year, right as the pandemic was getting going, and that was episode 96. So he reached out to us and offered to come and join us. So we had him back. So we have him at the end. He's a real estate expert, economist, self-professed Canadian housing macro credit ninja, he says, and he's a founder of Edge, Realty Analytics, and North Cove Advisors. Interesting segment.
He's a real estate analyst. And I think he told us last time that a lot of his clients are like institutional investors, maybe fund managers and stuff like that. So he's doing real estate analysis that's helping give them information to do stuff. And so as you'd expect, he's got lots of interesting insights and commentary on Canadian real estate. Now, in the Rational Minded community, there was a discussion recently about the fact that the beginning of our podcast, we say that it's for Canadians. And people, it's not the first time this has happened. Where people say, I'm not Canadian and I enjoy your podcast. You should take that out of the intro because it might deter some people. And we've always said that we're going to keep it in there because our expertise comes from a Canadian perspective, and we are Canadian and our clients are Canadian.
Yep.
Anyway, this is one of those episodes where when Ben Rabidoux starts talking, it's pretty Canadian specific. So people might still want to listen to it if you're interested in the dynamics of the Canadian real estate market.
Definitely.
But it's that's about as heavy of a Canadian tilt as we've had for a while in terms of the content.
So I've got some great new content for you. I found this podcast, I think I've mentioned it before, but Masters of Scale with Reid Hoffman, he founder of LinkedIn. Anyways, his podcast I always enjoyed, but I always found it over-engineered. So I listened to a recent interview that he had with Satya Nadella from Microsoft. And he mentioned in the podcast that they now have the full interviews behind a paywall. So I looked into it, $100 a year US, and you get extended interviews with these people. They are phenomenal interviews. He is a great interviewer, especially when you take out all what I think is over-engineering. And I listened to Phil Knight of Nike. Wow. Man, we talked about Shoe Dog before. Really good, really interesting interview. And then also Satya Nadella. So I just discovered this the other day, but I wanted to pass that along. Worth $100. We also talked about the book Nudge a couple of weeks ago. So the co-author of that book, Richard Thaler, was on with Stephen Dubner on Freakonomics. Great interview. And then this being the week after 9/11, I don't know if you checked out the documentary on Netflix called Turning Point 9/11, the war on terror.
I saw that it was there. I didn't watch it.
It's really good because it starts with the event, but then it goes back through recent history in terms of what led up to this. And I learned a ton, so it was really good. And also 60 Minutes on Sunday night did a special on the captains of the fire department, and they did this really sad, dramatic timeline of when leadership of the fire department arrived on scene, and then they took some of the audio that they had and merged it with audio from people who were unfortunately in the building and weren't saved. And they showed the timeline as they were approaching each other in the building while they climbed the stairs. Incredible. So that's 60 Minutes from this past weekend. A couple of nice reviews we received lately. One of them is even going to get us a free beer if they come and visit. K-Town Brown said, "This is by far my favorite financial podcast. Love the format, variety, and the banter. Also refers to how much time and effort that we must and our team must spend behind the scenes to put this thing together."
Come on. It's no time at all.
No time at all. And speaking of the team, we wanted to welcome Sandrine to our team. So she's joined us and Angelica to pull this all together and help us on, especially the social media part of the endeavor. We also heard from Mikey88. Love the podcast. Fills in the void of information with real fact-filled information and little fluff. So I don't think either of us have been accused of a ton of fluff. From Matt Furumori, refreshing to have such amazing content from a Canadian perspective. And then from N.R. Fisher, it's refreshing to listen to a finance podcast that is strong and open bias to indexing, but is willing to openly discuss the trade-offs and benefits of other investing approaches.
like we talked to Jack Vogel for the live webinar, which was recorded yesterday. And then we had Antonio Pica from Vanguard, who runs their factor strategies, earlier this week. And I'll tell you, the black and white idea of indexing good, other stuff bad, it's many shades of gray. I think there was a time where I thought, like many people do, index investing is good, period. But it's so much more nuanced than that.
It sure is. Lastly, from the store, lots of interest in the Talking Sense cards. They are really a great conversation starter. So if you have kids over the age of 7, hop online. Angelica put a bonus in there. If you spend, you buy $15 more, you get 20% off the cards or something, and you get a free pair of socks. So highly recommend it. Good value. Anything else, Ben?
No, that's good. The only other thing I'll say is because we finished the episode with Ben Rabidoux, so I'm going to say this now. We do always appreciate the reviews that people leave. So yeah, if you're enjoying the podcast, or if you're new to the podcast and haven't left a review yet, then we appreciate you doing so. Welcome to episode 168 of the Rash Reminder podcast.
So quick, couple of recent books for you. One is we had to prepare for our interview with Cam Harvey that's coming up in 3 weeks, I believe. So you and I both dove into his most recent book, DeFi and the Future of Finance, which is co-authored by Ashwin Ramachandran and Joey Santoro. Suffice to say, great book. Hard to understand it all, of course. I think you could do a complete undergraduate degree on learning about cryptocurrency and blockchain technology. But you really do understand the kind of impact this could have. So many people in our industry roll their eyes when you talk about Bitcoin or cryptocurrency. But this is no joke. This is a very serious development. Some people say it's as important as the internet. I have way, way more questions than answers. You're probably ahead of me on understanding all of this. It feels a bit like the late 90s, with pets.com, that whole era where companies transitioned from that to today, which is Amazon and Shopify and the like. So I'm not sure how this will all shake out. I don't know how it's going to affect our industry. I don't know how.
Nobody's sure.
No one's sure. How will companies adapt? How will the regulators adapt?
And we, like in your pets.com example, we asked Cam Harvey about that, about, if somebody had told you in the 90s that the internet was going to be huge and that business was going to move to the internet. It was like, cool, someone could have told you that and been right, but nobody knew what to invest in to capture that.
Right.
And for the most part, if you invested in stuff, you blew up. And I asked Cam, is it going to be like that with DeFi and crypto? And he just had a blank stare and said, it's going to be way worse because it's moving way faster than the internet ever did.
Exactly.
And it's changing way more quickly. So, but I think one of our big takeaways, Cameron, from the reading that book, and I know you've read other books on the topic since then because you read like a machine, like an actual reading robot. I think the big takeaway is that it's what you said, is that it's not something to roll your eyes at. It is meaningful. It is going to change. It's going to change something.
Yeah.
Cam Harvey described it as not like the internet. It's the missing piece of the internet is how he described it.
So I started reading another book called Blockchain Bubble or Revolution, which is much more pragmatic. So I kind of linked that. So they talked about, well, how will this work? So is one example I read this morning, I actually sent you a screenshot of it, is cryptocurrency or Bitcoin, is it an investment or is it currency? Right now, many people are buying it as an investment, but you want your investment to go up. You don't want your currency to go up because that causes all kinds of problems. So which is it? Is it digital gold? I don't know. And then I think back to, off the top, I mentioned that interview that Reid Hoffman did with Phil Knight, like Nike. Think of a company like Nike, public company, 74,000 employees, true global company. Think of the impact of of blockchain technology, cryptocurrency on that. Like, there's still going to be shoes bought. We all need shoes and clothing. Think of all the shipping, all the retail stores. Like, it's massive. And there's no way that Nike is not going to be, I wouldn't think, not be aware of the impact of blockchain technology.
I think Cam's point when we talk to him is that there are segments of the economy that are going to be disintermediated by this, and then the rest of the economy that's not being disrupted is going to become much more efficient, and access to capital is going to increase and all that kind of stuff. So he sees it as a big opportunity. But one of my other big takeaways from talking to him is that it's not about a digital gold so much as it is a platform that will facilitate or can facilitate decentralized finance. So if you want to invest in decentralized finance, if you believe that it is going to disrupt traditional finance and revolutionize the monetary system, one of the ways to invest in that is by investing in these platform tokens like Bitcoin and Ethereum. But it's not a speculative bet on, it's not gold, it's not a store of value. It's saying, okay, decentralized finance is going to change everything. And one of the ways to capture that is by investing in the platforms that are going to allow it to happen. That was my take.
Anyways, we'll keep learning. There's a whole lot to learn.
Yeah, I don't know what you do with it is the other problem. It's like the 1990s example. It's like, okay, say I agree. I don't know if I do or not, but say I agree that, yeah, this is it. DeFi is going to be huge. Crypto is going to be huge. The way you capture that is by investing in the coins that are going to facilitate all this. I don't know which coins are going to facilitate all the growth. Is it going to be Ethereum? Maybe it's best positioned to do it, but there are new coins developing all the time. And a lot of it comes back to which one do people trust the most. And I just don't know how you predict that. So I really don't know what you do with this information. But like I said before, the big learning for us was that it's not a silly joke. It's not a speculative mess, although it has been. A lot of it has been that. And I think that's why people have dismissed it. But there's something to all of it.
Definitely is. In other news, quickly, a story I saw this week talked about how much change is potentially coming at us. Like, cryptocurrency wasn't enough change for us, but Walgreens is now getting into our space. They're offering a bank account and credit card wrapped up in a service that they call Scarlet, which will include some personal finance planning tools and financial wellness via an app. You'll be able to establish your goals, track cash flow, pay bills, link multiple family members' cards together to do an aggregation of your spending patterns. So I thought that was interesting. Someone who you wouldn't think is in our space at all. Like, people have said, Amazon's coming after you or Apple, but here we have Walgreens. So I thought that was an interesting story.
Raises a question of what is our space even, right? Because there have been so many technology platforms that have looked for a minute like they were going to change everything and disrupt everything, and that our business was going to be disrupted. But you realize pretty quickly that what people want is expertise from humans. And it's not just the expertise on, which account should I put my money in or what should my asset allocation be. It's it almost sounds tacky to say, but it's the human touch and being able to take the human experience and apply it to making financial decisions. And you can make as many apps as you want. Maybe an app can eventually do that. I don't know. I don't know if an app can be human. That's
something, as you mentioned off the top, around indexing. It's so nuanced. It's so particular to the individual, their preferences, their employment, their human capital,
their cash flow betas.
Yeah.
Reading John Cochran's paper too many times. All right. Should we jump into our listener question?
Yep.
And if we didn't really explain this, but our main topic today, or what would normally be the sort of meaty investing topic or financial planning topic, that's where we had Ben Rabidoux in. But we do have a listener question, which is easily a normal investing topic. So I don't think we're missing any content. It's almost like we have Ben Rabidoux in addition to a normal episode.
I'm looking at the notes here, and there's enough beef here to keep everybody happy.
That's good. People like the beef, except not actual beef, because when I posted a picture of the steak that I was grilling in the Rational Reminder community, I got some grief for that because somebody else had posted. There's a thread in the Rational Reminder community called Scenes While Listening to Rational Reminder, where people post pictures of what they're looking at while they're listening to the podcast. So it's a really neat thread, actually. And somebody had posted a picture of themselves hiking at a glacial lake, and I posted a picture of steaks that I was cooking on an open fire, which I do occasionally. And there was a discussion in the community about the glaciers melting, and then people pointed at me and said that one of the best ways to stop that is by not eating steak. So it was shouldn't have posted the steak picture. Anyway, I said that it was a miss-steak to post the picture.
It's pretty funny.
I thought it was pretty funny.
Pretty catchy, yeah.
So the listener question that we're going to answer is from Joel S. And it was actually the first listener question in the thread that Angelica posted asking for listener questions. It was posted back in July. And there's a great bank of questions in there, and we appreciate people continuing to post them. So the question is, considering the replication crisis in academic journals and that papers that fail to replicate are cited up to 16 times more than those that were replicated, should this affect our approach of research-based investment decisions? It's a really good question, and I think there's a pretty good answer. And there were a couple other discussions in the Rational Minder community, and actually one was an email that I got that tie into this. So I wanted to kind of address them all together because I think they fit together. So I got an email from Richard, and I posted that email in the listener question thread in the community. And this is a majorly condensed version of their question, but they're asking why an expected return based on historical data should carry any weight in decision making. And he used the example in his email of the U.S. beating emerging markets for the last 30 years. Does that mean that we should expect the U.S. to beat emerging markets going forward? And he's using that as an analogy to say, value stocks have done well historically. Why should we expect them to do well going forward? And it's an interesting question. And then we also had somebody post after our after episode 166, 2 episodes ago, we had talked about the exceptional outcome of the U.S. stock market. We were talking about 100+ years of lessons from 100 years of stock returns was the basis of that episode. And so Mr. Bozo, hilarious. Come on, how can I not laugh at that? Mr. Bozo in the community asked if the U.S. has been this outlier for 120 years. Like, is that not long enough to say that it's going to continue to outperform in the future? Like, how much data do we need to believe that this is going to continue? And that's also an interesting question. So that's kind of 3 questions that are all related once you start talking through them. So we'll start with the replication crisis, or as Cliff Asness calls it in his blog post on this topic, the replication crisis that wasn't. So you can kind of see where this is going to go. Is there a replication crisis in financial economics? Cam Harvey, who's an upcoming guest in episode 171, he gave some fascinating commentary on the incentives in academic finance. He told us that the vast majority of schools in the world will give you tenure. They'll give you a job for life. Well, I'm assuming he meant tenure. They'll give you a job for life if you get a single publication in the Journal of Finance. Mm-hmm. And journals are ranked by their impact factor. So the impact factor is the number of citations from other journals to the journal in question. And if people are citing work that's published in the Journal of Finance a lot, which they do, and it does have the highest impact factor of financial economics journals, then that's what happens. So if other people are citing Journal of Finance works, then it increases its impact factor, and that journal does have the highest impact factor. Then the other aspect that is a little bit more nuanced is that research papers with a positive result. So that means you propose a hypothesis and your hypothesis is supported by the data as opposed to rejected by the data. Those are much more likely to get cited. And then the negative results don't get cited. So if you're a researcher and you're thinking about wanting to get published because you want to get tenure, which who wouldn't, I'm assuming, in academia, then you're going to look for significant positive results. So you kind of put all that together and you end up with what we have, which is a zoo of factors. And that was coined by John Cochran, who's another upcoming guest in episode 169. He created that title in his presidential address to the American Finance Association. And the zoo currently has roughly 400 species in it, animals, factors, I don't know. Probably more than that, because that Cam Harvey started a paper, sort of an open source paper, I think it was a couple of years ago, to try and find all the factors. And I think people can still make contributions to that if they find new factors. So probably more than 400 at this point. Now, given all that, it sounds like we're pretty ripe for a replication crisis in finance. But I think it's a little bit more nuanced than that. When we're thinking about factors, and Larry's the one that came up with a great framework to think through this. But two of the big things you got to think about are testing out a sample. And that's where you're going to see replication die, I guess, in many cases. But from our perspective, we're not going to be interested in a factor if it has not been tested out of sample. So that's one. But then the other big one is that there's got to be a sensible explanation for the premium. So if we take the value factor as an example, Fama and French had their big paper in 1992 using U.S. stock market data from 1963 to 1990. It's a pretty small sample in a single market, so could have been spurious easily. It's a tiny slice of history. They're testing one metric. They're testing book to market. Maybe it didn't work with earnings or some other scaling fundamental. But Fama and French went on to test that out of sample in a 1998 paper using 13 international markets from 1975 to 1995, and again found a robust value premium, I think in 12 of the 13 countries. And then in 2007, going back from their original paper from 1929 to 1963, they again found a robust premium. Both of those papers were published in the Journal of Finance, for whatever that's worth. Then we have Asness, Moskowitz, and Peterson. They looked at value and momentum jointly in individual stocks, global stock indexes, currencies, global government bonds, and commodity futures, and found, again, robust value premiums everywhere. Their paper was value and momentum everywhere. And then there's an interesting one that I found. Cliff linked this in his blog post on this topic. This was using return series from Goatsman and Cowles. And those return series go back to 1825. And they had value and momentum data. So from 1825 to 1926, they again found a value premium that looked pretty similar to the 1926 to 2020 value premium, again for U.S. stocks.
Sorry to interrupt, but speaking of Cliff, I shared with you the interview he did with the CFA Society of Orlando. Excellent interview.
I have not listened to it.
A lot of discussion there that relates to exactly what you're talking about here. So well worth checking out. Podcast, easy to find. Yeah,
we can link it in the notes too. And then there's the most recent paper from Fama and French that everybody got all excited about, where they showed that in the most recent sample, so the most recent 30-ish year period, 30-year period, they found that the U.S. value premium was smaller and not statistically significant. So everyone's like, oh, the value premium is dead. But the whole point of their paper was that you cannot conclude statistically that the value premium has changed from the prior period to the current period. So the realized outcome was not great, but we can't conclude anything. We can't infer anything from that, at least not reliably. So that was a lot about historical data that I just talked about, using the value premium as an example. Yeah, there's similar data for momentum. And for other factors too. But value and momentum are the ones where we have data going back to like the ridiculous 1800s and stuff like that. But in both cases, this is the important part, there's also a story. Why do these premiums exist? If there's no explanation, even if we have a mountain of data, it's pretty hard to think that the trend is going to persist, especially if it means taking on more risk or cost to try and capture it, which is the part that's really important. If pursuing value didn't lead to any tracking error risk relative to the market or some other benchmark, then none of this would be relevant. You would try and get the premium. But taking on the premium means increasing concentration and typically increasing costs and turnover and all that kind of stuff. So if we're not sure if this thing's going, and for momentum, I mean, that's even more exacerbated, where the transaction costs are higher, the turnover is higher, the fees tend to be higher too. So even if this thing shows up in the data, if we're not comfortable that it's going to persist in the future based on the theoretical explanation, then you might not go after it. Now, if we think about asset pricing in general, there are two main theories. One is that expected returns are explained by persistent behavioral errors. And the other one is that expected returns are explained by risks that investors need to be compensated for while they're holding the asset. They're kind of two competing theories. The truth is probably somewhere in between the two. For value, we know that there are really strong explanations on both sides. And the other thing that's important to keep in mind is that these theories stand on their own. They're not just explanations for value. It's not like, look what happened to value stocks. Let's make up an explanation for it. You can test these theories elsewhere. Like, for example, value stocks do tend to be under distress. They tend to have high financial leverage. They face substantial uncertainty in future earnings. And they tend to be riskier than growth stocks in bad economic times and only slightly less risky in good times. So you take that and it's like, okay, there's more to it than just saying, oh, look, the returns were higher, it must have been riskier. Yeah. There are other ways to test whether that theory makes sense. And then for the behavioral explanation, again, we know that humans extrapolate too far into the future. They assume trends exist where they don't, and they overreact to news. That can be tested outside of finance even, but it also applies to financial economics. So again, we can test the theory even outside of finance in that case. And that all leads to value stocks to trade at prices below their fundamentals, to be underpriced, which leads to higher returns for the people that hold them. So in both cases, there's pretty robust theory that can be tested in sample, being like in asset pricing, but also outside of this field completely. So then the other side of that example is finding trends that look like they exist. I mean, think about if you take the 1825 to 2020 sample, you could take that data and massage it and find something that looks like a robust pattern. Robert Novi-Marx had a kind of tongue-in-cheek paper where he found that anomalies were explained by sunspots, the weather, global warming, and the stars. So that's the kind of case where it's like, I don't care how much data you show me. If you're going to tell me that we're going to build a fund based on sunspots, I'm not going to pay 60 basis points to own it.
No.
So if there's no sensible reason to assume that the returns are going to persist, again, we're back to not believing in the thing. The other famous examples are butter production in Bangladesh predicting market returns, and the team that wins the Super Bowl, or the conference, I think, that wins the Super Bowl. I don't know enough about football. That might have sounded completely clueless. And then the starting letter of the company's name. There's statistically reliable anomalies that exist, but who's going to put money into that strategy? Well, nobody, because there's no reason to believe that they're going to persist in the future. So we're talking about replication in financial economics and whether we should believe the data when we're building these investment strategies. I think there probably is a replication crisis within the factor zoo if we're talking about 400 factors, but we're not building portfolios based on all 400 factors or even on most of the newer factors. But there is a small subset of factors that do meet the out-of-sample robustness and the theoretical sensibility. Even within that debate of which asset pricing model makes sense. Like, is it the 4-factor model, the 5-factor model? Do you include momentum? Is it the 6-factor model? All of the factors that we're debating there are robust theoretically and empirically. So if there's a replication crisis in those factors, then I think that would be a problem. But there's a 2021 paper by Jensen, Kelly, and Peterson titled, "Is There a Replication Crisis in Finance?" And they test the claims that factor research findings have, one, and this is a quote from the paper, this is the claim that they're testing, that research findings have no internal validity, Most studies cannot be replicated with the same data because of coding errors or faulty statistics, or are not robust in the sense that the main results cannot be replicated using slightly different methodologies and or slightly different data. And then the second one that they're testing is that the research findings have no external validity. Most studies may be robustly replicated but are spurious and driven by p-hacking, that is, finding significant results by testing multiple hypotheses without controlling the false discovery rate. Such spurious results are not expected to replicate in other samples or time periods, in part because the sheer number of factors is simply too large or too fast growing to be believable. So the way they set their paper up is they analyzed 153 factors across 93 countries using a Bayesian framework, which is effective for making reliable inferences in the face of multiple testing. Wow. Their framework starts with the prior belief that factors have zero expected return and allows the in-sample results to incrementally increase the estimated premium. So they're starting out with the assumption or with the belief that factors have zero premium, and then they're letting their framework update their belief when they're running these tests based on the observations. So you're starting out though with the assumption that the expected factor premium is zero, and then letting the data tell you the truth. So what they found is that the majority of asset pricing factors can be replicated, can be clustered into 13 themes, the majority of which are significant parts of the tangency portfolio. They work out of sample in a new large data set covering 93 countries. That's the other thing they did in this paper is they also tested them out of sample.
It's crazy.
Yeah. And they have evidence that is strengthened and not weakened by the large number of observed factors. Also interesting, the 13 themes were accruals, debt issuance, investment, leverage, low risk, momentum, profit growth, profitability, quality, seasonality, size, skewness, and value. So they're saying all of the 100 and some odd factors that they tested fit into these 13 themes, and for the most part, I think they had like a 75% or 85%, depending on which segment they were testing, replication rate, which is not terrible. So they conclude U.S. equity factors have a high degree of internal validity in the sense that over 80%, there it is, 80%, over 80% of factors remain significant after modifications in factor construction that make all factors consistent, more implementable, while still capturing the original signal and after accounting for multiple testing concerns. And then another quote, we show that some out-of-sample factor decay is to be expected in light of Bayesian posteriors based on published evidence. Therefore, the new evidence from post-publication data largely confirms the Bayesian beliefs, which has led to relatively stable Bayesian alpha estimates over time. So if we think back to Larry Swedrow's criteria for a factor that you want to pursue, it's got to be persistent through time, pervasive across markets and asset classes, robust to alternative specifications, investable after transaction costs, and sensible. So I think this most recent paper gives us more evidence on the data side that the factors that we care about are persistent, pervasive, and robust. The sensible part has never been a concern, really, because on the theory side, I think we've always been pretty comfortable with the stuff that we're pursuing. I think in a lot of ways it's a bit of a caution for new research. If you see a fund that's based on like this new thing, look at this new thing that we found. Exactly. That's always going to be a risk. We talked to Cam Harvey about that too. But to answer the question, is there a replication crisis in finance or does it extend to finance? Not in a way that should affect the way that we invest. Maybe in the way that we assess new research as it comes out. And that's been Cam Harvey's big point. He's said that like, with the amount of factors that have already been discovered and the amount of testing that's already been done, the new T-stat threshold for a new factor has got to be a T-stat of 3, is one of his one of the things that Cam Harvey said in the last few years, and I think that's probably sensible. Like if there are 400 factors in the zoo, the 401st might need some additional rigor to be confident that it wasn't spurious. Yeah. Now the second part of the question, or the second two questions that I lumped into this one question, is how does this apply to countries? If we go back and think through the U.S. stock market, it's this massive outlier in terms of performance. But if you tie that back to theory, why would that persist? And the answer to that's not so obvious. I love the piece that Cliff did on the long run lying to you. The long run is lying to you. He shows in that blog post that almost all of the U.S. outperformance relative to international stocks from 1980 to 2020, almost all of it is explained by the expansion of U.S. price multiples relative to international price multiples. U.S. businesses did not do better, but their how expensive they were per unit of earnings increased more. So they got more expensive. Now, do we bet on that continuing? Well, I don't know. We just talked through the reasons that you might believe that lower prices predict higher future returns and higher prices predict lower future returns. If we extrapolate the U.S. experience in terms of returns further into the future, we're implicitly assuming further multiple expansion. Or maybe massive fundamental outperformance, I guess, could also happen, and stable valuations. But if we look out of sample and say what has the experience of other countries been, because you can't how do you look out of sample for the U.S.? I don't know how you do that. You look at other countries, that's out of sample. Well, if we look at other countries, we know that just like stocks, just like within each country market, cheaper countries, and this is something that Dimson, Marsh, and Staunton have looked at pretty extensively, cheaper countries tend to perform better than more expensive countries. Yep. You can build a country rotation strategy, in the historical data at least, that produces superior returns. So U.S. is expensive. I don't know if it's the most expensive market. I haven't looked at P/E ratios for every single country, but the U.S. is up there. It's pretty expensive right now. So should we look at the U.S. experience and say, yep, we expect that in the future? I don't know. I think that's pretty tricky to say. Dimson, Marsh, and Staunton had a recent paper, 2021 paper, on this, basically on U.S. exceptionalism, and they had a pretty interesting analogy. They said focusing on U.S. returns and treating them as expected returns is like taking Google's parent company Alphabet's returns as an estimate of future expected stock returns. The past performance of individual stocks is largely uninformative about their future returns. But when there's ex post selection biased on past success, historical mean returns will provide an upward biased estimate of future expected returns. So I want to estimate stock returns. Say, okay, well, Google's done the best. So let's take that as our expected return. Well, that doesn't make sense. And most people would agree that doesn't make sense. Taking the U.S. and assuming that's going to be future returns is kind of similar. That's the analogy that they're trying to draw there. And they make the pretty obvious statement that this is why equity market expected returns are usually based on or related to the performance of the entire stock market, including the unsuccessful and successful stocks. And we know from the Besson-Binder stuff that there are many more unsuccessful stocks than successful ones, but the most successful ones tend to do exceptionally well. So it's the same kind of reason why we shouldn't just take the best performing stock market geographically and decide that one is going to is the best description of how stocks are going to do in the future. And likewise, we shouldn't necessarily take that market and decide it's going to continue to outperform everything else in the future. The other point that they make in their paper is that the U.S. market was nothing in 1792. That's when stocks started trading in New York, 1792. And today it's almost 60% of the global market cap. The U.S. was an emerging market that ended up ex post being an economic powerhouse. Yep. But nobody could have predicted that at the time. If you tell me what the next economic powerhouse is going to be in 120 years, then yeah, sure, we should we let's invest there. But I don't know anybody that can tell you that. And I don't even know if that's the right thing to say, because we know that economic growth doesn't correlate that well with stock returns in all cases. In the case of the U.S., it clearly did. And then the other big thing we have to remember is that the U.S. was spared, for the most part, from the devastation in the major world wars. And a lot of other countries that were previously economic powerhouses were devastated. Mm-hmm. And they had to go through massive recapitalization just to get their economy back in order. But when you go through that massive recapitalization you end up diluting your earnings per share growth. That's the fascinating paper that Rob Arnott did, showing that there's not a great relationship between economic growth and returns. He used that as one of his examples where he showed the countries that were most devastated by major wars. I think it was World War II that he was looking at. They had massive economic growth, but their earnings per share growth trailed the most. The biggest gap between earnings per share growth and GDP growth was for those countries because they were being recapitalized. It was new capital being added, new share issuance. So the earnings per share growth trailed significantly. And it's been like that in the US too. It just hasn't trailed as much as it did in those examples. And the last point I want to make on this is Cliff had another paper. We're talking about a lot of Cliff papers today. It's not a bad guy to reference, I guess. No. He's got a 2011 paper, International Diversification Works bracket eventually. And in that paper, they find that in the long run, markets don't tend to crash at the same time. The point of the paper is in the short run, if you take 2008, correlations go to 1, as people tend to say. Correlations increase in really bad times. So some people said after 2008, diversification doesn't work. International diversification's broken. So the premise of this paper is that sure, in a panic, in the short run, that's true. But let's look at the very long run. And if you look at the very long run, all of a sudden, over, I can't remember the time period, 30-year periods or 50-year periods, markets don't crash at the same time. And it's because short-term market panics, they're driven by different economics. But in the long run, it's the country's specific economic performance that dominates. I mean, you could almost say it's the discount rate changing in the short run, but it's the economic experience that drives the long-term outcome. So Cliff finishes that paper saying, diversification protects investors against the adverse effects of holding concentrated positions in countries with poor long-term economic performance. Let us not fail to appreciate the benefits of this protection. So that's it. No replication crisis, and I don't think that we can extrapolate the U.S. experience into the future.
And K-Town Brown should be put on notice that when he takes us out for those beer, might be a couple beer if we get many questions from him. That was a great answer. Shall we go over and welcome Ben Rabidoux to the podcast?
Yeah, let's bring Ben Rabidoux on the podcast, and people will also be able to hear Ben answer the Talking Sense cards this week, which I thought was pretty fun.
So Ben, it's awesome to have you back on the podcast with us. You're one of only a few repeat guests on the show, so it's great to have you.
Well, it's great to be back, guys. Thanks for the invitation.
It's kind of funny time because you joined us back in April of 2020 when the pandemic was just really getting going and rocking the economy. And at that time, I remember you painted a pretty bleak picture of the economic landscape in Canada and how the household finances might turn out. And you talked about some pretty negative implications, especially for real estate. So here we are, a year and a half later. Suffice to say, predictions may not have all been accurate. So how do you look at what happened?
Yeah, it's to be clear, when we spoke, it was looking pretty precarious. And actually, if I rewind back just a little before the pandemic hit, there were some concerning signs even before we hit that recession, right? And then we talked about this, but maybe just as a refresher, we were seeing things like the debt service ratio was rising to a 30-year high. And so this is the share of household income that's being diverted towards paying debt, right? And of course, this was at a time where interest rates, even back then, were hovering near record lows. We had consumer insolvencies were rising quite rapidly. And so, all of a sudden you throw into that this enormous economic shock, right? And from where I sat, it certainly looked like it was shaping up to be a pretty rough patch for households in Canada. Now, what was amazing is not only was that wrong, but it was like, it was wrong directionally, right? It wasn't even like the magnitude was wrong. It was completely wrong directionally. What I mean by that is this is the first recession on record where households come out the other end in better shape than they went in, right? And so you can measure this in a number of ways. But if we look even at something like, credit card debt, Credit card debt today in Canada is about 18% lower than it was when the pandemic hit. People have paid off their credit cards.
Isn't that amazing?
We have $250 billion in excess savings just sitting on the sidelines. That's about 10% of GDP. Savings rates spiked, right? Which is, again, something that we've never really seen. Normally in a recession, especially in the early days, people draw down their savings to stay afloat in aggregate, right? Because you have job losses and so on. We saw income growth actually accelerated during the pandemic. Now, a lot of that was these enormous government transfers, which was really the story of all of this, is that, I don't think I appreciated at the time the magnitude of the sort of government support that we would see, right? Something to the tune of 20% of GDP in terms of transfers to households. And then some of the other programs that came into effect, the mortgage deferrals, et cetera. So, here we are today. By the way, consumer insolvencies are sitting near 20-year lows, right? So no one's defaulting, right? Credit card insolvencies, all-time low. Credit card delinquencies, all-time lows, right? So, it's such a strange pandemic or such a strange recession in that we went into it with all of what would seem to be the hallmarks of a really nasty sort of balance sheet type recession that had a lot of potential negative ramifications for households and for the broader economy. And not only did none of that pan out, but it was literally the opposite, that we came out the other side of that with households in better shape. Now, the corollary of that is that, really what we've seen is that the government has pulled a lot of that risk onto the sovereign balance sheet, right? And of course, we can discuss, how much, whether those programs were targeted sufficiently, or whatever it might be, whether it was too excessive, all this stuff. But the point being, the government absolutely stopped what would have been a really terrible outcome with just an unprecedented, just flood of liquidity to households. And I guess thank God they did, because we were looking at a really nasty outcome.
Mm-hmm.
Does that explain the unexpected spike in real estate prices that we've seen?
No. So that's it's related to that, but it's a bit of a different dynamic. So the way I see what happened with housing in Canada, first off, if we go back just prior to the onset of the recession, we had housing inventory in Canada that was already sitting at 20-year lows. Right. So this is before the pandemic hit. So it was an extremely tight market. And before the pandemic hit, what was funny is, we talked just as things were starting to unravel. But had we spoken a month earlier and had you said, hey, what are you saying to your clients? I would have said, well, actually, we're pretty constructive on housing, because in as much as I'm concerned about the balance sheet of households, the supply-demand dynamics in the resale market are just extremely positive. Right. Well, now the recession hit, and for about 4 or 5 months, we saw everything was turned on its head. We saw, a big surge in inventory, an enormous drop in sales, but it was really maybe a 4-month issue, and then it completely went the other way. And so you had this dynamic where we had a shortage of single family inventory before the pandemic hit. And I want to focus in on single family, because this is where it gets really interesting. And in fact, if we back up from that, and we let's look at the decades leading up to the 2000s, because this helps explain a lot about how we ended up where we are right now in Canada. So if you look at the decades, every decade, 1970s, 1980s, 1990s, and the 2000s, we pretty consistently averaged about 3.1 million people added to the Canadian population each decade, right? And in turn, we built about 1.3 million new single-family houses. And so that was a pretty consistent ratio each decade. Well, then you hit the 2010s. So this is the decade ending just last year. And all of a sudden, population growth ballooned to 4 million in that decade, but the number of new single-family homes built dropped to 1.1 million. And so you had this tremendous imbalance in what was being delivered now, and what was in demand. And then you throw on top of that a pandemic where now what's in demand is lower density suburban living. Everyone wants out of their condo. Everyone wants out of the big city. Everyone wants a recreational property. And that's the exact thing that we were in shortage of heading into the recession, right? And so, there was a temporary blip where we saw prices drop. It was, literally a 3-month affair. And then it just did a rapid U-turn and away we went. Now you throw on top of that record low interest rates. You throw on top of that the income growth, which shockingly hit 20% during the recession. Again, something we've never seen before. That's just the magnitude of the fiscal response from the feds. And you had a lot of freed up income from things like the mortgage deferrals, and people just demand just took back off again, right? And so here we are. So it was sort of a perfect storm that everybody, myself included, missed. In that, we all expected this would be a negative outcome for housing. It was anything but.
Why do you think the industry was so slow in providing supply of housing?
Well, it's been a chronic issue for years, right? And so I think that's a complicated question, and there's a lot of sort of theories on why that is. If you just look at just basic housing starts, or let's say the stock of or the pipeline of construction of new homes that are under construction, or they're coming, that will be built, it's very high. It's at a record high, in fact, right? Housing starts are sitting at 40-year highs, right? But then when you dig into that, you find that most of that is actually apartments, both rentals and condos, right? And what we haven't been building enough of is single family. And so you've seen a shift over time away from lower density and into higher density. Now, some of that is sort of driven by regulation. So you have, higher density requirements on municipalities. You have greenbelt regulations, but some of it is just what we might call, NIMBYism, right? Not in my backyard. And it's a weird thing. See, this is one of the issues with housing in Canada that I've sort of coming to appreciate more and more, is it's like one of the things that we can't question in Canada is immigration policy, right? And I think that's a mistake, because look, I want to be really clear on this. We need a high level of immigration in this country. And if you doubt that, all you have to do is pull up a chart that shows the natural increase in the population over time. And so that is like births minus deaths. And it's just been plunging, right? So Canadians are making fewer and fewer Canadians. And so we need a strong level of immigration. Okay. And so I don't want to be that person that's like, we don't need immigration. We absolutely need immigration. But the issue is, we have the immigration targets that are set at the federal level, but the housing is actually permitted and delivered at the municipal level, where you have politicians that literally have to deal with their neighbors, right? That they have to live with these people that are, complaining, well, I don't want this development in our neighborhood. I don't want this going on. And so you end up with a scenario where, the immigration targets are not necessarily, they don't align with the ability or the willingness sometimes of municipalities to deliver the housing needed. And so to give you an extreme example, back in 2019, we had a confluence of factors that led to just this incredible population growth. You had a lot of non-permanent residents that were coming here. And so these were primarily international students and work permit holders, because the labor market was so tight. But you also had very strong immigration. So we were adding almost 600,000 people to the population. Now, I'll just say, I don't believe that we have the physical trades to deliver enough housing to meet that level of population growth. And so where I stand, that's a policy error. And again, it's not that I don't support strong immigration levels. It's that we need to be thoughtful about, where are we going to put everyone, and how do we incentivize municipalities to build, and to sort of ignore the NIMBYs that are like, oh, I don't want it. We don't want new development. Well, we can't have that if we're going to have robust immigration, right? And so, I know you guys want to get into housing policies in the election, and it's encouraging to me that a couple of the parties have picked up on that and are trying to find ways to bring municipalities on board and bring more housing supply.
We talked about the price increase. You talked a little bit about the dynamics, the detached home price increase primarily. You talked a little bit about the dynamics there. Do you think that where prices are now, are they supported by fundamentals, or are we seeing a, in quotation marks, bubble?
Yeah, well, look, there's almost no question that some of the house price increases we've seen are just patently absurd. And I'll use as an example. Well, what's been really interesting during this particular cycle in the last, let's say, year and a half, has been that it hasn't been the Torontos and the Vancouvers that have led. It's been the smaller metros, the secondary and the kind of the tertiary markets. And in particular, like, to put up an example, you look at some of the smaller metros in Ontario, and especially those that skew more towards like the recreational properties, right? So, North Bay up 50% year over year, right? Like, you've got like the Kawarthas up 50%. You've got, my neck of the woods, which is like Grey Bruce, Owen Sound, around to Southern Georgian Bay, up, 45, 50% year over year. Like, these are crazy moves. So none of that's justified, I don't believe. And so it would not surprise me whatsoever to see some of those places settle back, because you just can't sustain that sort of a price increase. Is it a bubble? Like a year and a half or 2 years ago, I would have said definitely. It's more, my views kind of gotten a little more nuanced in that, like, I've come to appreciate that there really is a shortage of supply, and we've underbuilt. So is something a bubble if there's an actual shortage of supply? I don't know. I'm very concerned about household leverage, notwithstanding that it looks better than it did a year ago. What really concerns me is when we pull back and we look at the extent to which housing has driven the economy. Okay, now we talked about this last time I was on, but I'm telling you, it's gone even crazier since then. So residential investment, which is it's sort of three components, right? It's new construction, it's renovation expenditures, and it's let's just call them like transfer costs, so things like realtor fees and legals, etc. Just those three things are now 10% of Canadian GDP, right?
Jeez.
Where prior to the election, or prior to the recession, it was like 7.5%. And so it's one thing to look at it at an absolute level, but if you look at how much of the growth, right, it's been 2/3 of the economic growth since coming out of the bottom of the recession has just been housing. And if you go back over 4 years, it's still almost 60% of the growth. So, I mean, this is just getting, like, to me, that's the bigger question, is like, well, is it a bubble? Is it not a bubble? Like, there's really concerning dynamics, but there's also very valid, there's a real shortage of supply. And so, is that a bubble? I don't know. But what I would say is you just can't have an economy that is that levered to housing. And one more example that's really stunning to me is if we look at, you look at all investment across an economy, right? So you look at what governments are doing, you look at what businesses are doing, you look at what households are doing as it relates to real estate. And so, we call all of that gross fixed capital formation. I know it's getting a little technical for the purpose of a personal finance podcast, but we call that gross fixed capital formation. So you look at, well, what is the share of gross fixed capital formation that's just real estate, just residential real estate? And in Canada, it's about 44%. Okay, and you go, well, what does that mean? Well, here's what it means. Over the last 20 years, there have only been a couple of OECD countries that have ever gotten close to that. And they are Spain, Greece, and Ireland in kind of 26, 27, 28, prior to their major meltdowns there. And the reason why this is so concerning is it tells us that we are investing, like, if you picture, for every $100 that are being invested in the economy, you have less and less of that that's being invested in new businesses and things that make us more productive as an economy. And you've got more and more of it that's being directed towards just real estate. Right. And so then it begs the question, well, where are the incomes? Where's the productivity going to come from to support house prices going forward? And that's really what concerns me. So to me, the bigger question is not, is it a bubble, but like, how do we grow the economy in a way that, that benefits people and is sort of less reliant on this housing boom and more reliant on actual productivity growth going forward? And I don't have an answer for that.
I'm going to give you a definition of a bubble, Ben, from a paper on housing bubbles. It's quoting the economist Joseph Stiglitz. They say, if the reason that the price is high today is only because investors believe that the selling price is high tomorrow, when fundamental factors do not seem to justify such a price, then a bubble exists.
Yeah. Well, okay. So I get that. So, but I think it's more nuanced than that, right? Like, you can get into things like inelasticity of supply and all this other stuff. On the expectation side, what I would say is there's absolutely some concerning dynamics on that front, right? So, for example, Bloomberg Nanos has this great consumer confidence index, and one subcomponent of that is real estate expectations, right? And so we probably remember 2017. We sort of had that little mini boom and bubble here in Southern Ontario when they brought, and it was kind of popped when they brought in the foreign buyer tax, and you saw some parts of Toronto, you saw prices come down like 10 or 20% in, like, parts of the 905, let's say. And if you go back and you look at, well, were real estate expectations looking like then? I mean, the chart, I think the index level hit something like 47, right? Which, that doesn't really mean anything, but it's kind of bumped along around 40 or whatever, jumped up to 47, back down to 40. And then all of a sudden in 2020, late 2020, early 2021, it spiked to like 60. Okay, so it was like way above the 2017 highs, and it's just started to roll over now. And when you then overlay on top of that like you're talking now nationally, we've got over 1/5 of all homes being purchased or being bought by investors. Now, I don't know. I mean, we don't have like
Wow.
great historical data on that, but that's data from the Bank of Canada, and it's a little higher as you would expect in the big cities like Toronto and Vancouver. But they estimate that on average, it's across the country, it's 1 in 5. And again, I don't know what that looked like in the U.S. at the peak. I would think it was probably higher in the U.S. at the peak, but that's still concerning to me because, when you start getting into, we talked about the fundamentals. One of the things I wrestle with is let's look at condos in Toronto as sort of like your typical investment vehicle, right? So I track this pretty closely, and I have sort of a cash flow index, right? That looks at, well, what are the typical rents? What's the typical price, typical interest rate? And you sort of look at, well, if you bought today at 80% LTV, what would your cash flow be from day one, accounting for all your expenses? And like, it's generally been kind of positive over the years by like $100, $200. Then it flipped negative like in 2016, and it's just kept going more and more and more negative.
Wow.
And so now here's what's interesting though, and here's again where like my thinking's getting a little more nuanced on that. So then you say, okay, who in their right mind buys a condo today where they're out of pocket $500? Well, so then as I was talking to people about this, I realized that, well, actually what they're thinking is I'm out of pocket $500, but my mortgage is, let's say, $2,500. And at today's interest rates, from day one, almost 2/3 of that is principal repayment.
Mm.
And so I might be out $500 out of pocket, but I'm up $1,700 in principal repayment. And so then what I did is, well, I thought, okay, well, that makes sense. So then I updated that index to include what it looks like once you account for principal repayment, and it's like effectively unchanged. Now, I don't love that math. I hate the idea of being out of pocket on an investment. And like in theory, it's building equity, but I'm feeding the fire every month. But I get the mindset. And so it's just sort of like, it gets back to this dynamics, like low interest rates have distorted everything in the world, right? And so I don't know how I feel about that, but again, would you call that a bubble? Like, I don't know anymore. It's a little more nuanced, I think, than I used to think.
Yeah, that is really interesting. Do you have data on like the frequency of transactions or the holding period for when people are buying houses? Like, are people flipping properties, I guess is what I'm asking?
Yeah, it's a great question. So I don't have data on that. The people that have done the best work on that, John Pasalis, who's he's a real estate broker in Toronto, but he's a super smart guy. He's doing his PhD at the U of T. He's a really bright guy. And he's done some great work because he has access to the MLS, which the average person like me does not have. As a broker, he can go in and he can pull that data. And so what he found, I don't think he's updated it more recently, but it was exactly what you would expect to see in 2017, and where you saw this sharp increase in people flipping in especially the 905 around Toronto. I would assume that that's happening now. I think certainly, if you correlated it to like real estate expectations index that we talked about, I mean, it's a pretty clean fit. So as you expect prices to rise more, you generally see more speculative activity overall. So no question that's happening in Canada right now.
What's going on in the rental market?
Well, that's a really interesting dynamic. So getting back to the pandemic, right? One of the things that happened early on in the pandemic is we saw population growth absolutely plunged, right? So again, 2019, just before the onset of the pandemic, we were running almost 600,000 year over year. Today, we're 150,000 year over year. So it's like it's been cut by 3/4. So that's the lowest we've seen. Like as far back as we have data, we've never seen the population growing this slowly. And yet housing demand is huge. So you're like, well, how in the world do we square this? Well, what happened and what's not captured in the aggregate data is you have to think about population as sort of 3 buckets, right? And so the first is, let's call it net international migration. So what we generally think of as immigration, right? And you have people coming here from other countries. You have some people that leave Canada. And so that nets out on average to kind of 250 to 300,000 a year. Then you've got the second bucket, which is natural increase, which is like Canadians making new Canadians minus the ones that are dying. And that, of course, has been a trend that's just been plunging over time, as we discussed. But the third one, and the one that really moves the needle quarter to quarter, and that's very volatile, is this net non-permanent residents. And so this is like your foreign students and your work permit holders. And that's super volatile. In 2019, it was adding almost 200,000 to the population. Now, as soon as the pandemic hit, one of the things we saw is you saw foreign students were like, wait a minute, I can take this class online. I don't need to be here. I can go home and be with my family during this pandemic. I'm out of here. right? And so you saw a huge outflow of foreign students. And then you had a lot of the work permit holders. Well, all of a sudden, the unemployment rate hits, effectively 25% once you accounted for all the people that were technically employed but not working or that were discouraged. A lot of those non-permanent workers, their contracts weren't renewed. They went home. And so that number actually went like massively negative, about 150,000 negative. And so that really is what accounted for that steep slowdown in population growth. Now, the reason why that matters, and the reason I highlight it here, is because those are primarily renters, right? And so you had this strange dynamic early in the pandemic where population growth plunged, but it was driven by an exodus of renters. And so you saw rental demand in places like Toronto, and especially in the condo market, were hit very hard, right? And so, we saw at peak, rents for condos were off about 25%, right, from their peak levels. Now, we're now to the point where the borders are starting to reopen. We've got international students returning. And so the rental market is tightening quite significantly, right? It's still not back to where it was at peak, but it's gotten much better. By my estimates, as I track it, we've seen rental prices in Toronto for condos have increased 10% in just the last 2 months. Right? So pretty dramatic. But what I would say is longer term, Canada is famous for like fighting the last battle. And to me, there was like a rental crisis in some of these big cities in 2018 and 2019, which was driven by this enormous surge of non-permanent residents, right? Almost 200,000 year over year across Canada, right? We did not have enough rental space to house everybody. So now what we've seen is if you look at rental units under construction across the country, they're absolutely surging. We're at about 100,000 rental units under construction across Canada and building more every day. And so in my mind, I actually think that going forward, I don't think we're going to hit peak, like get back to peak population growth for many years, but yet we're going to have a lot of new rental supply coming. So I actually think the rental market, the worst is behind us, but we're not going back to those 2018, 2019 crazy tight levels for probably many years. So I don't know if that answers your question, but it was weak. It's gotten better. I don't think we're going to go back to those crazy rental prices. I think we got a lot of supply in the pipeline that's going to make it better for renters going forward.
All right, so we had this potential for a real estate decline that never actually happened, and now we've seen prices just skyrocket. Do you think we have a whole generation of Canadians at this point that just don't believe that real estate prices can decline?
It's a great question. It's funny because we've now seen you talk about like classical conditioning here. You saw like in 2008, when the financial crisis hit, we had like the mildest of real estate recessions, like 6 months long, and then it snapped back, right? Yeah. And then you fast forward, if you were in Vancouver, they had like a little mini correction in 2016 that snapped back. In Toronto, we had one in 2017 that snapped back. Now nationally, you had one in 2020 that snapped back. You're right. I mean, you can't be faulted for thinking that, that housing only is sort of a one-way bet and any dip is to be bought. Now, I think that sets up for disappointment because we've seen long stretches where housing has returned negative in real terms for a decade. Right, we saw that in the 90s and the early into the mid 2000s. Right, but what I would say is, I did not foresee the extent to which the government would roll out measures specifically to support housing. Right, so I mean everything from the Bank of Canada buying mortgage bonds to drive interest rates lower, QE just generally driving rates lower, mortgage deferrals. I mean all of these programs. Rental assistance, deferring rents, and all of these things that were targeted towards maintaining asset values. And I don't know if you remember, like before the election was called, you had Adam Vaughan, who at the time was like the parliamentary secretary on housing, and he had this he was on like one of the political shows. I forget which one it was, and he was basically they were talking about this housing affordability issue, and he basically came right out and he said like this government's never going to do anything that's going to jeopardize housing equity. Right. And like, I'm starting to realize that is unfortunately the view of the government is you've got 2/3 of the population are homeowners and home ownership, it represents an enormous amount of typical household's net worth. You can't do anything that's going to affect that and expect to be reelected. So, I don't know what that looks like going forward. I feel like the government's just got a very different view on supporting housing going forward. I don't think it's a healthy thing. right? I really don't. I think, if you want to make housing more affordable, you let prices fall. I mean, it's that simple, right? It's otherwise, all these other measures that we've seen proposed where it's like, well, we'll let you take on debt and pay it off a little longer. Well, it doesn't really solve the problem. All it does is make credit more available, and it helps the first handful of people that buy, but it drives up prices for everybody else. So I don't know, guys. I don't know. I just think that we're in an era now where there's a lot of experimental economic thinking. MMT and running deficits don't matter, and so if deficits don't matter, well, what can't you do to support house prices? Right? I don't know. It's going to be a different dynamic than what we've seen in the past.
So you mentioned solving problems, and this is not a political podcast, but we are in the midst of an election here in Canada. So can you talk about what some of the possible solutions are to these problems you talk about?
Well, I'll tell you the ones that encourage me the most, and there's sort of a couple of variations of them, specifically and again, it's not to be political, it's not to endorse anything, just to be clear. But both the conservatives and the liberals in their housing platforms had sort of similar approaches where they wanted to tie funding for municipalities to some of these density targets and these construction targets that we talked about, right? And so the idea there is they want to say, look, if you exceed your density targets and you build more housing than you sort of had said you would, then there's literally a monetary value attached to that. And there's a couple different, the conservatives are more around funding transit and infrastructure, and the liberals haven't really laid it out super clearly, but it sounds like it's like a monetary value that you just get if you hit these targets. And I think that's really important. That's, I think, getting back to what we talked about. I think they're recognizing that at the end of the day, the gatekeepers to the housing supply issue are these municipalities, and you've got these people that are elected that they have to deal with literally their neighbors, right? And they have to keep them happy as opposed to potentially ticking them off and building houses for people down the road that may or may not vote for them, right? So you understand. So that to me is really encouraging. Other than that, a lot of it relates to trying to bring about new rental supply and affordable housing. And there's some kind of cockamamie, crazy ideas around, different programs to help people save up for down payments. And honestly, to me, the most encouraging thing in all of it is just trying to find ways to get municipalities on board. And the other thing I thought was kind of interesting is like some of the proposals around freeing up some of the land that's held by that are basically federal government assets that could be then redeveloped for new housing. So there's for the first time, I think we're actually seeing some kind of out of the box thinking. The other thing that's certainly welcome is like anything that is going to target unwanted speculation, which I guess is any kind of speculation. All of it, I guess, is unwanted in a sense.
Right.
But the stuff that's like, I think sometimes we find the wrong enemy. Like if they're talking about, well, we want to target flippers that go in and they buy a house and they renovate it and then they resell it. Well, like to me, that's not really the enemy here, right? Like that person, they're adding some value to the house and then they're selling it again. Like I don't really get too worked up about that. Where I think it matters a lot is if you get like non-resident demand, right? And you get people that are buying that aren't here in Canada. They don't intend to. They're not renting. It's out of the rental stock and it's out of the ownership pool. That's a real problem. And again, like we don't really know how big that is, and there's been some conflicting data on that front. But I don't really think it matters. It's just like it makes sense. We're in a housing crisis. We don't want to be this sort of porous country for illicit capital. So we want to tighten up. And the one that I think makes the most sense is on that front is where the Liberals have come out and basically said, we're going to build a beneficial ownership registry, right? And so for your listeners, what that means is if you're going to own a home in Canada and you're going to put it in, let's say, a numbered company, right? So let's use sort of I guess this would be like a cliche example, but let's say you're a wealthy business person in China, right? And most wealthy business people in China got there through some level, like, graft and like just corruption, right? And so you want to move some of your assets outside the purview of Beijing because tomorrow if they want, they can take your money, they can take your life, right? It's a very different system, and so you want to go to Canada, but you don't want it to be very easily found that it's you that owns it, right? And so what you do is you set up a numbered company and you have like a person at the law office that's like the secretary, and there's just no way to trace it back to you, right? Even though you're the beneficial owner. And so what they've said is, well, that's not going to fly. We want to know every house in Canada who actually owns it, right? And I think that's, and not only know, but have it searchable, have it as a searchable database. And To the extent that there is some illicit capital that's flowing into Canada, I think it's very clear that there is. That's a huge deterrent, because if you're trying to hide money, the last thing you want is a searchable database that your government back at home can search up and be, hey, how did you get the money to buy this place, right? So I think stuff like that, you're finally starting to see that sort of stuff. And it's hard to know how much that moves the needle, but it's one of those things where it's like, well, if it makes sense, let's just do it, right? There's no downside to doing that.
What role do you think the private debt market is playing in Canadian real estate?
It is significant. I want to be clear. It's not a huge number. Right? So when we talk about like private lenders and mortgage investment corporations, for example, as a share of total mortgages outstanding, they're still relatively small, right? But in terms of their growth and the share of incremental volume that they're accounting for, it's much more significant. And you have to remember that it's much more so now because you have more stringent regulations around the stress test. And so some people that otherwise might have been with a big bank are now, they find they can't borrow as much anymore. And so the next best thing is these hard money private lenders. It's very difficult to get good data on it. But I'll tell you, like I spend a lot of time just talking to folks in the mortgage industry to sort of have a sense of what's going on. And they're all very much of the view that volumes in that space are exploding. Like they're very high. And we've talked about this before. These are generally 1-year loans, interest only. Oftentimes the financing capital behind them is sort of risky, not risky, flighty, let's say, right? Mom and pop, they're retired, they're looking for a little bit more yield. And so it's interesting. During the pandemic, one of the things we saw from a number of these mortgage investment corporations is that they gated redemptions, right? And some of them stopped paying their dividend. And so, it's a good reminder for your listeners that you might think this looks like an interesting opportunity. And it could be. There are some well-run, very thoughtful, risk-oriented managers out there that I've personally met. And I would trust these guys with my investment capital, no problem. But you have to understand that in times of crisis, when you may want liquidity, that's the exact time where you can't get it, right? And so, we saw that during the recession. The other thing that we've seen more recently is you've seen some pretty nasty stories coming out about some of these bigger debt funds that are less so on the mortgage side, but more on the private business loan side. That it's very clear now that you've got all sorts of conflicts of interest that were happening behind the scenes. Sending money to personal friends, getting kickbacks on some of these deals. I mean, that's the problem with this, is they're relatively loosely regulated, and the opportunity for abuse is very high. So I would say, my personal preference is, like, in general, they're not a great investment unless you really feel like the person well who's running it. Because there's a lot of trust that has to be put into whoever's running it. For most people, that's just not, you can't do that level of due diligence.
So when we see pitch decks saying that private debt funds are going to give equity-like returns with bond-like risk, it's too good to be true.
Look, man, okay, I don't mind saying this. Like, I think there's a handful of these out there that are just outright frauds. And I think, the stuff that's coming to light, you just shake your head. Like, how is it not fraud, right? It's fraud, right? So, I don't want to get too far into, because as you guys know, I've had my fair share of legal run-ins for stirring the pot. So I don't need any more of that. But I will tell you, like, in having done some analysis on some of these, like, you can see where they've lent a lot of money to a specific company. You can follow that company through the bankruptcy proceedings. You can see the court say there is no recovery for the creditor. And this is not like a small loan for this portfolio. And you'll never find it. Their returns just keep ticking up. Like, it's like straight line, no losses, no write-downs, nothing. Wow. And I look at that and I'm just like, that literally is impossible. Right. And so I've seen this. I'm not going to throw out any names, but I've seen this in doing some of the due diligence on some of these.
Wow.
I'm convinced they're frauds. So that's just I don't want to get into any more than that. Here's what I would say is, if you're thinking about investing in any of these, and I would run as far away from some of those as I could, but if you're thinking of investing in some, go out and pull up the portfolio of the loans involved, and just search and see if any of those companies are in trouble, right? And especially if they've been through any sort of bankruptcy proceedings, because all that's public record, right? So at any rate, I mean, I'll let you guys decide if you want to leave that part in. We haven't named any names or anything, but there's some really just suspect stuff happening in that space, to say the least.
I see no reason not to leave it in. I think that was
That's good.
That was good.
One last question about housing prices. So instead of making a prediction on housing prices and where they might go, can you talk about what the data say when prices have been this high relative to some sort of economic fundamental?
Well, sure. Well, actually, let me first start by saying, or at least painting a picture of where we actually are in the housing cycle. So we can kind of think about this mathematically, right? So right now in Canada, there's a really important measure that's called months of inventory in the housing sector. And the way that it works is, let's say, there's 100 homes for sale in this neighborhood and 20 of them sold last month. You would say there's 5 months of inventory. It would take 5 months to sell those 100 homes at the current rate of 20 sales a month, okay? And so I use 5 because that's actually the long-term, actually a little higher than that is the long-term. Long-term average closer to 6. But 5 is important because at 5, you don't get prices begin to flatline until you hit 5 months of inventory. Okay, now let's back up and look at where we are in Canada. Last month, there were 2.2 months of inventory. Okay, this is among the lowest we've ever seen. So then you say to yourself, well, what does that mean mathematically? Well, what it means is we need housing supply to effectively rise somewhere in the order of 130% from current levels, or you need sales to fall somewhere around 60%, or some combination of the two, before you get back to that 5 level where we can reasonably expect prices to flatline. So when we can finally expect like a soft landing of sorts, okay? So that's just to frame the picture of like how far away we are from a balanced market. This is like the furthest thing from a balanced market. Now, having said that, so you talk about house prices. A couple interesting observations. In the second quarter, we saw real house price growth in excess of 20%. So real house prices, accounting for inflation, up 20%. We've never seen that. And we have data going back at least to the 60s in Canada. We've never seen anything like that. So folks who may be listening who remember the 1970s cycle, we had a housing cycle then, late 70s, had a pretty nasty cycle, late 80s. Never did we see house prices, real house prices, hit 20%, right? So, you get back to talking about kind of the fundamentals, they're very stretched. On an affordability perspective, like when we look at carrying costs as a share of disposable income, they're right near the all-time highs, especially in that single family segment. And that's with interest rates at record lows. So look, I'm not saying that, we can't see, I'm not saying we're not stretched from a valuation perspective. I think all signs are that we're absolutely crazy and at the extremes. I just, at this point, a lot needs to change before we get back to a balanced market. And the reason I highlight that is the housing market's like a big ship. It doesn't stop on a dime. It doesn't turn suddenly, right? It's a slow moving ship. And so, even if we saw sales start to weaken and we finally started to see some inventory build in these big cities, this is not a story for 2021, right? And it may not be a story for 2022, right? It may be that it's going to take a while for inventory to build and prices will start to, maybe the back half of 2022, we start seeing the market back in more balance, but we've got a long ways to go.
That's great. Thanks, Ben.
Yeah, fascinating stuff.
So we finish off every segment, every episode we go through some talking sense cards. You willing to join us?
Yeah, let's do it.
So these are the cards from University of Chicago Financial Education Initiative. So Ben and I just pick cards at random, and we just ask each other the questions and see where it goes. You want the first one, Ben? How do you avoid spending money you've saved?
Oh, great question. Well, I think a lot of times if you talk to people and you ask them, well, why did you end up dipping into this savings pot? The answer is often an unexpected expenditure, right? Most people that have a pot of savings don't touch it unless they absolutely have to. And so, I think that gets back to kind of the point around having an emergency fund in addition to having like a pot of savings. And an emergency fund that's meant to be tapped into as opposed to your long-term savings. Because it's very difficult to have a pot of savings without accounting for the fact that life just throws curveballs at you, right? So I'd leave it at that and see if Ben has anything else to add.
I think that's a pretty good answer. I mean, I think shoveling money into accounts like an RSP or an RESP where there's some negative implications to pull it out, that can definitely help as a deterrent. But I think the proactive approach of having the emergency fund to avoid doing that makes a lot more sense. But the question was, what was the question again, Cameron?
How do you avoid spending money you've saved?
Yeah, so the emergency fund is that's the correct answer. What would you say, Cameron?
Oh, I try to map out big spending items ahead of time. So I try to plan these. As I get older, I find I get less enjoyment out of buying stuff, which used to be my enemy in the past. But so now it's mainly trips. We plan those out. Okay, Ben Felix, I'll let you go first on this one. Would you rather have a job that made you rich or one that made you happy?
Well, it's kind of a tricky question because if you had a job that made you rich, it doesn't give you any timelines there. If you had a job that you didn't have to work for very long that made you rich quickly, then you could do whatever you wanted afterwards. If I had to work the job for an extended period of time, if it's a 30-year horizon for the question, then I would rather the job that I enjoy rather than one that makes me rich. There's no sense in being rich 30 years from now if I'm going to be miserable the whole time. So I think the question's a little bit misspecified.
Ben, what do you think?
So I don't know if you guys listen to Scott Galloway at all.
Yep.
Profit and NYU. I find
Prof
him.
G.
Yeah, Prof G. Yeah, funny and often insightful. And I thought one of the things that the point he raised, I thought kind of resonated. Is he said, like, find what you're good at, right? Because he said, like, you get all these people that come to these commencement speeches and they talk about, pursue your passion. You look at how they made their money. It's like coal mining or just some obscure that no one goes into for the love of it, right? And he makes good points. Like, find what you're good at, and then put in the time and the effort to become great at that thing. And then once you stand out from everyone, then all of a sudden you'll find that you actually really enjoy being the expert at that thing. And most often, the financial aspect will follow in suit, and you end up in a career that has a lot of the positive elements. You enjoy it and you make a lot of money. And I think that's actually really good advice, because I think oftentimes, we'll find something that you just love to do, and you get kids that jump into these degrees that there's no real future for them or whatever it might be, right? It's like, well, no, find what you're good at and then become great, and then you'll enjoy it and you'll make a lot of money.
Good answer. I'll go first in this last one. What is something you can do for hours without realizing how much time has passed? So I would say for me, it's learning about our industry. And people know this. They hear Ben and I talk about this a lot on the podcast, different other podcasts you listen to or books. But I can get into a zone where I'm listening to material about our business, our industry, or just business in general. And I could just go for hours and not even realize it. So that's mine.
Sounds like you're in the zone that Ben Rabidoux just described a second ago.
Yeah. Ben Felix, what do you think?
When I really get lost in time is when I'm doing the 3D modeling stuff on the computer. Like if I'm designing a new combat robot in Fusion 360, I can lose 7-8 hours no problem. Forget to eat. That's it for me.
Yeah, for me it's fishing. I mean, put me on a lake in a boat, and I mean, I'll fish till it's dark, and just totally lose track of time. That's my passion.
It's interesting. None of us mentioned scrolling through TikTok.
Yeah, I don't have TikTok. I don't even have Instagram. I'm way behind.
Yeah, you and me both.
You're not even on Reels. Reels is the hottest thing apparently. So I'm just learning.
I don't even know what that is.
There we go. Anyways, Ben, it's been a blast to have you join us this week.
Well, thanks for having me, guys. It's been great to catch up.
And to everyone out there, thanks for listening. We really appreciate it.
Well, thanks, guys. Probably a very different tone than last time, but it's such a strange market. I don't know if things break one way or the other. I'd love to come back on if we actually see things actually breaking. But I just don't. Man, it's such a crazy. I mean, you guys must see it. You guys are over Ottawa way, right? Like,
prices
it's
are
a crazy
crazy
market out there.
Yeah, it's nuts.
There's fields of houses going in around where I am in the South End. Fields, like hundreds and hundreds.
Yeah. There's a lot of new construction. I did some modeling on that, though. I mean, you take what's under construction, and if you added all of it to, like, all the single family housing to existing inventory in the resale market, it's like, man, you're only back to like inventory levels we saw in 2016. Like, we're just so low on inventory. So I don't know what changes that, right?
Wow.
But it's moving in the right direction for sure. It's definitely, we're seeing a lot more new construction, and so hopefully that translates into a balanced market. But it's not going to be this year. It just won't.
Cool. Great to see you.
Thanks, guys. Thanks for having me. Appreciate
Thanks
it.
again.
All right, Ben.
All right, guys.
See you,
Take
man.
care.
All the best.
Yeah, same to you.